Thank you, Shokji. Hello, everyone. Good morning. Good morning, Sanjay. Good morning, Bibu. So maybe we can wait for a minute or so. Let's everybody join in and then we will start. How the preparations are going on.
Fine, sir. It's going fine.
Going good. Okay. Okay. So I think we should start now. I hope everybody has joined in. Again, a very warm welcome to everybody. And the topic for the day is in days 33. Okay. Earning per share. So earning per share, is a measure of the, profitability per share of the company as a whole, right? And this is one of the key, measure the investor focuses upon, right? So what is the earning per share the company is earning, right? So why we are calculating the earning per share, how it helps. So anyway, we know, how much the profit company is earning or how much the loss company is incurring. Then what's the point in calculating earning per share? Any idea why we are, unnecessarily spending time to divide the profits by the number of shares? Why we are going to do this?
So that each shareholder could know what he is earning on his shares.
Hmm. Right. Any other reason? Whatever thoughts you have, you just share so that we can collect all the possible reasons.
Because they are the sir ultimate shareholders.
Hmm. Okay. See, so earning per share basically tells us how much earnings, post tax earnings per share the company is earning, right? So, suppose if I take an example, give me a second. Okay. Suppose if I take an example, so there are two companies, A Limited, right, and B Limited, right? They are in the same set of business, right? For example, both the companies are in steel sector. Okay, right? Now, as an investor, I want to invest in either of the two companies, right? Suppose these are the only two companies available in the steel sector, and one of the investor wants to, pursue any of these two companies and want to invest, right? A Limited also has its balance sheet and P&L available. B Limited also has its balance sheet and P&L available. Suppose A Limited says that equity share capital of 10 crore. B Limited says equity share capital of 100 crore. Then profit is suppose 5 crore. And then profit is suppose 15 crore, right? And then other assets and other balance sheet, all that stuff, right? So if a investor wants to pursue its investment decision basis on these annual reports, right? So he will say that A Limited is earning 5 crore and B Limited is earning 15 crore, right? So it means B Limited is better because B Limited is earning more profits, right? So with this limited information, we will arrive at this decision only, correct? If we want to take a decision basis on the overall profitability of the company, then B Limited looks better, right? Because it is earning 15 crore, which is higher as compared to the 5 crore. Yes or no?
Yes.
Correct. Then we calculate the say earning per share, right? So 5 crore divided by 1 crore. So 10 crore of rupees 10 each. So 5 crore divided by 1 crore. So 5 rupees, right? Rupees 5 per share, right? And here 15 crore divided by 10, 1.5, right? So rupees 1.5 per share, right? Correct. Now,
Yes.
when we calculate the earning per share, we come to know that A Limited is actually better performing because it is earning 5 rupees for each share, while B Limited is only earning 1.5 rupees for each share. Yes or no?
Yes.
So the investor who was taking the decision basis on the overall profits would have invested in B Limited, but a better, smarter investor now will say no, 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 no. B Limited is not better. Rather, A Limited is better, right? Because per share it is earning more, right, as compared to the B Limited. Then again, one more smart investor comes and says, boss, now it also depends how much we are paying, right? The only thing how much profit per share the company is earning doesn't matter. It also depends how much we are paying for this company, right? Suppose the share price of the company in the exchange, if it is listed or if even if it is not listed, the investor is required to pay. Suppose in this case is rupees say 100, okay, and suppose in this case it is 300, okay. Now because 100 rupees the investor is required to pay for each share, so how much what would be the price by earning? So 100 divided by 5, 20, right? P by E, price by earning, correct?
Yes. P ratio is
P ratio is 20, and how much P ratio here it is?
200.
300 divided by 1.5, 200, if I am correct,
Yes. Yes.
right?
Correct.
So now this the third investor will say eventually that A Limited is better. Why? Because A Limited's P by E is 20, which is less than the P by E of B Limited, right? Now, why P by E ratio is so important? Because it tells you the payback period of your investment, right? So if you are giving 100 rupees for one share and you are earning 5 rupees each year, right? Then it will take 20 years to return your investment amount, correct? That's what this ratio tells us. Yes or no?
Yes.
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 And in case of B Limited, what is happening? I'm giving 300 rupees today because the share price of B Limited is quoting at 300, and I will earn 1.5 rupees every year. So it will take 200 years for me to get my 300 back or the payback period, right? So P by E ratio is the most, favorable ratio among the investors. Now, in order to calculate the P by E, we have to calculate the earning per share mandatorily. Yes or no?
Yes.
Right? So that's why this standard is important because this standard requires mandatory disclosure of the earning per share on the face of the P&L, right, by all the companies who are preparing their financial statements under Ind AS, right? So Ind AS 33 mandates to report earning per share on the financial statements. If this standard doesn't mandate, or if this there is no such a standard requiring to disclose the earning per share or calculate earning per share, then it will be difficult for investors to take their informed decisions about their investment prospects. And the whole idea of preparing and presenting these financial statements along with so much extensive disclosure is what? To equip the users of the financial statements. Yes or no?
Yes.
With better information, right? So that's the whole idea. So under Ind AS 33, we will understand how the earning per share is calculated. And there are two versions of earning per share. Number one is the basic earning per share, and number two is the diluted earning per share, right? So we will understand how the basic earning per share is calculated and how the diluted earning per share is calculated, and how anti-dilutive adjustments, are ignored, right? So in case dilutive earning per share is not dilutive, rather anti-dilutive, then the basic earning per share will be considered as the diluted earning per share as well, right? So in that case, basic earning per share and diluted earning per share will remain same, right? So that's the overall overview why we are studying this earning per share and why we are calculating this earning per share, right? So what's the objective? Now, another point. How many of you believe that whatever adjustments we are going to understand in this standard are only for the purpose of calculation of earning per share, and we are not going to do any accounting for those adjustments in our books of accounts? So my question is, whatever adjustments we are going to study under this Ind AS in order to calculate the earnings available for equity shareholders, divide by weighted average number of shares, that's the formula. So whatever adjustments in the numerator and denominator we are going to study under this Ind AS, are those adjustments required to be accounted for as well in the books of accounts?
I think not.
Okay. Any others? Any other thoughts? So somebody is responding in the chat box. So Leela is saying yes. No. So whatever adjustments we are going to study today under this Ind AS, right? Ind AS 33, we are not going to take the impact of those adjustments in our accounting, right? So that is solely for the purpose of calculation of earnings per share. Is that clear to everybody? So we are not going to make any changes in our accounting, whatever we are doing in our financial statements, right? So for the purpose of this standard only, we will make those adjustments in the earnings attributable to equity shareholders or ordinary shareholders divided by the weighted average number of shares, right? So we are not going to make any changes in our books of accounts. All these workings are only solely for the purpose of calculation of EPS. Is that clear?
Clear.
Right? Okay. Now let's proceed what the standard has for us to discuss today. So as I just mentioned, objective of this standard is to prescribe the principles for the determination of the earning per share. So this standard tells how earning per share is computed. What are the rules which we need to follow while calculation of earning per share? And earning per share includes both basic as well as diluted. And then this standard also guides us how those calculated basic earning per share and diluted earning per share needs to be presented in the financial statements, right? And why this standard is asking us to, calculate and present earning per share? Because it helps in improving the performance comparison between the companies within the same reporting period, right? Different companies for the same reporting period, or same company for different reporting periods, right? So what does that mean? So different entities for the same reporting period. Like I took the example of A Limited and B Limited. Both are preparing their financial statements for March 25 and they have computed or arrived at their earning per share. And basis on that earning per share, we will come to know which company is performing better, right? What if A Limited previous year 2023, 2024 and 2025, right? So these are the three annual reports available for A Limited. In 2023, the earning per share for the company was rupees, say 3 rupees. In 2024, it was 4 rupees. And in 2025, it is 5 rupees. Now, what this indicates? Does this indicate that A Limited is, upward trending in terms of its profitability year on year basis? Yes or
Yes.
no?
Yes.
Right? So this standard helps to understand and compare the different companies for the same financial year and as well as the same company for the different financial year to understand how the company is performing vis-a-vis its past performance and vis-a-vis other competitors or peers in the same industry, right? So that's the overall objective of this standard to calculate and present the earning per share by all the India's reporting companies. Now, what is in scope? Are there any exceptions, relaxations, exemptions available that certain set of companies will present the EPS, certain set of companies will not present the EPS? So what the standard says? So standard says apply to companies that have issued ordinary shares, right? So unless and until company does not have ordinary shares, it cannot calculate the earning per share, right? So that is the very basic thing. So company has to have a ordinary share capital, right? And anyway the company will have. So this condition is generally deemed met. Then entity that discloses EPS shall calculate and disclose EPS in accordance with Ind AS 33. And when the entity is required to present both consolidated financial statements as well as separate financial statements, then disclosure required by this standard shall be presented in both CFS as well as SFS. So the standard says simple three things. Number one, whether the company has ordinary share capital, yes or no. If the answer is yes, standard is applicable, right? Then standard says these entities which have the ordinary share capital needs to disclose EPS mandatorily. So the standard is mandatory on all these companies. Then standard says if the company is preparing both consolidated as well as standalone financials, then in both the financials EPS disclosure is mandatory, right? And if the entity present EPS in CFS based on the information given in CFS only, and similarly EPS in the SFS based on the information given in SFS only. So that is quite logical, right? So earning per share for the consolidated financial statement will be calculated basis on what? Standalone financials earnings or the consolidated P&L earning, consolidated financial earnings. Of course, consolidated financial earnings, right? So after the consolidation, whatever the consolidated P&L, has the profit or loss, basis on that only the earning per share or diluted earning per share will be calculated. So standard says number one, company should have the ordinary shares issued, that is it should have the equity share capital, number one. Number two, EPS will be disclosed in accordance with its standard mandatorily by these companies. And number three, if the company is preparing CFS as well as SFS, then disclose EPS in both the financials. And if the company is not preparing CFS, only preparing SFS, then disclose in SFS only. Of course, if CFS is not prepared, then how you will disclose, right? Then the standard says in CFS, earnings per share will be calculated basis on the consolidated earnings, and in standalone financials or separate financial, EPS will be calculated basis on the standalone earnings, right? Any questions, doubts here? Easy. until now?
Yes, sir.
Okay. Now we need to understand couple of definitions before we actually proceed with the nitty-gritties of the standard, right? So what do you mean by the ordinary share? What are the ordinary shares?
Equity shares.
Equity shares. So standard has a very explicit definition. So standard says an ordinary share is an equity instrument that is subordinate to all other classes of equity instruments. So there could be different classes within the share capital. For example, preference share capital. Within the equity share capital as well, there could be a class A, class B, right? So standard says the ordinary share would be that class of share capital which is subordinate to all other classes, right? So if any other class has any special rights, right? For example, 10% annual fixed dividend, 7% premium redemption, right? So all those classes, have some special rights. So this class should be subordinate to all of them, right? So whatever is the leftover will belong to this class. So this class would be regarded as the ordinary share. Ordinary shares participate in profit for the period only after other types of shares such as preference shares have already participated, right? So that's what we are learning since ages, right? So whenever preference share capital is also there in the company, and suppose they have any special preferable rights, for example in terms of dividend rights or in terms of any other voting rights, so they are called preference. The word preference itself means they have some sort of preference over other class of shares, right? That's why they are called preference shares. So all the preference shares have already taken their dividends or any other benefits whatever they were uh, contracted. After that, whatever the profit or leftover earnings are left, that would belong to the ordinary shares, right? So that is called earnings attributable to equity shareholders. Are you able to recall this terminology we have been studying under the IGAP too, right? So whenever we
Yes.
used to calculate earnings per share, we never use the word profits of the company. We always use the word earnings attributable to equity shareholders. It means these are the leftover earnings after paying off all other types of preference shareholders or other lenders or other owners, right? So this earnings purely belong to the ordinary shares, right? An entity may have more than one class of ordinary shares. Of course, within the ordinary shares, they may have class A, class B, right? That is possible. There is no doubt about that. Then ordinary shares of the same class have the same rights to receive the dividends. In accordance with India's 32 financial instruments presentation, an equity instrument is defined as a contract that evidences a residual interest in the assets of the entity after deducting all of its liabilities. So this standard, India's 32, also defines what equity instrument means, right? So India's 33 is defining what? Ordinary share, right? And India's 32 is defining what? Equity instrument, right? So ordinary share is an equity instrument, right? So India's 33 says ordinary share is an equity instrument. And what equity instrument means? As per India's 32, the uh, equity instrument is defined as a contract between the company and the third party which evidences a residual interest. Residual means the leftover, whatever is left after everybody has taken the share of their cake, right? So whatever is leftover belongs to this class of people. So this class of people will be regarded as equity shareholders for the company after deducting all of its liabilities, right? Right, so that's what we have been studying under the IGAP as well. As such, nothing new we are discussing here, right? This is all same. Okay. Then there is one more type of share, the potential ordinary share. So what do you mean by the word potential? What is the potential?
That will be potentially converted into ordinary shares,
Right.
maybe convertible preference shares.
Correct. Correct. So convertible bonds, convertible preference shares, right? Options, which, if exercised, will be, you know, uh, uh, issued in the form of equity shares. So all those uh, instruments which have the power of, you know, issuing equity shares or receiving equity shares, right? So all those types of contracts will be regarded as potential ordinary share. So what's the standard? How the standard defines it? A potential ordinary share is a financial instrument or other contract that may entitle its holder to the ordinary shares. So, whoever is the person holding this contract, which entitles him some ordinary shares of the company at some future date, right? So, examples given by the standard are, for example, financial liabilities or equity instruments, including preference shares that are convertible into ordinary shares, options, and share warrants. Shares that would be issued upon the satisfaction of conditions resulting from contractual arrangements such as purchase of business or other assets, right? And ESOPs, employee stock option plans, shares. So those shares will also be issued at some future date to the employees, right? So all these instruments are not ordinary shares today, but they will or they may become ordinary shares or equity shares at some future date once certain conditions are satisfied, right? So these, because these are not yet issued in the form of ordinary shares, there is only a contract available that after certain period lapse or after, the exercise by the holder, the company will be issuing these shares to them. So these are called potential ordinary shares, right? So contracts that might result into in issue of ordinary shares of the entity to the holder of this contract at the option of the issuer, that is the company, right? Or the holder, right? The person who is holding this contract. So it is not always that holder needs to exercise. It is either way. Either the company wants to convert these, because company is allowed to convert at any time, so company can also convert the preference shares into equity shares, or holder can also ask for the conversion. He also has the rights. So it either or either the company can convert or the holder can ask for it, right? So in both the situations, this contract will be regarded as a potential ordinary share. Is that clear? Yes, no? Or do I need to
Clear,
repeat
sir.
anything? Okay, thanks. So, two key definitions given by the standard are ordinary share and the potential ordinary share, right? And equity share, equity instrument definition is defined under India's 32, right? Financial instruments. Financial instruments, I think, is not yet started in this batch, right?
Yes, sir. Now started.
Okay, understood. Then there are certain additional definitions given by the standard apart from these two key definitions, which we also need to understand first so that we are very clear theoretically what instrument means what, right? When we go down and start calculating the earning per share. Options, warrants, and their equivalents. So what do you mean by the options? Okay. Any guesses what options means? So let me simplify this. Suppose Reliance share is trading at rupees 2500 on NSE, right? Correct? And BSE. Correct? Now, since Reliance is also listed in future and options segments, right? And the future price is quoting at say 2510 one scenario, and in another scenario it is quoting at 2490, for example, right? Either at the spot price or at lesser than the spot price. Similarly, options are also trading. Option series is there, right? So options are also trading for different strike price. So for example, 2500 strike price option is also trading at rupees say 50. Okay, call option as well as put option, right? Now Mr. A has bought a call option of strike price 2500 by paying rupees 50. So what does this contract mean? So this contract means that Mr. A is ready to buy the Reliance shares at rupees 2500. Yes or no? Because he's purchasing the call option. Or Mr. A, if purchasing the put option, then it means he is ready to sell the Reliance shares in the market at 2500, right? So why I'm correlating this concept with the options traded on the exchange, just to better correlate what options means, right? So it is not only that options which are traded on the exchange are the options. Options could be non-traded options as well, which are option contracts given by the company to certain class of investors that they can, if they desire to purchase the shares of the company, they can exercise these options as and when they want, right? So they purchase these options and they wait for the right moment the company to set up and become profitable or meet whatever the profitability indicators or KPIs those investors have in their mind. So once those conditions, criterias of the KPIs are met, they eventually exercise these options and get ask the company to issue shares against these options, right? But in exchange, whatever the options are being traded, so those are traded only against the issued share capital. So that doesn't result into additional issuance of share capital, right? So options which we are going to talk about in this standard means those options which will require the additional shares to be issued by the company rather than those options which are being traded on the exchange in terms of future and option segment, right? So don't get confused with the options which are being traded on the exchange, right? So those are traded options which set to expire within the expiry date, right? So they doesn't result into additional issuance of equity share capital. So that is not we are talking about today. What we are talking about today is those option contracts which the company has entered into with certain class of investors, right? And if those investors exercise their right, then the company will issue additional share capital to them, right? So that will result into new shares being issued by the company, right? So those are called option contracts. Similarly, share warrants. So share warrants are also like some instruments which can be exercised, and against those share warrants, share capital or the shares will be given to the holder of those warrants, right? So options, warrants, and other similar instruments by whatever name called are financial instruments that give the holder the right to purchase ordinary shares from the company, right? Is that clear? Options, warrants, and any other similar contracts or any equivalent contracts by whatever name called are financial instruments that give the of holder the right to purchase ordinary shares of the company, right? And if they exercise their right, company will issue those shares by converting these options or warrants into the shares, right? So this exercise will result into additional number of shares being issued by the company, and hence it will increase the number of shares issued by the company, right? Then put options. Put options on ordinary shares are contracts that give the holder the right to sell the ordinary shares at a specific price for a given period. So this is just opposite of the call option. So under the call option, right, investor or the holder of those options was having a right to get the shares, and under the put option the holder of the put option has the right to return the shares, right, to the company, right, and company will eventually buy back those shares and they will cancel. It will result into reduced number of shares thereafter, right? So that's how options are impacting the number of shares of the company. Then the third definition is dilution. What we mean by dilution? Dilution is a reduction in earnings per share or an increase in loss per share resulting from the assumption that convertible instruments are converted into the ordinary shares after the satisfaction of specified conditions. So dilution means reduction in earnings per share. For example, A Limited was having a earnings attributable to equity shareholders for rupees, for example, rupees 100, and number of shares they were having 10, right? So earnings divided by number of shares, they were having a 10 rupees earning per share, EPS, right? Correct? 10 rupees EPS they had. Now, when we calculate the diluted earning per share by taking effect of the potential ordinary shares or convertible debentures, convertible bonds or convertible preference shares or options, warrants, any all these instruments which are not shares today, right? If they increase the profit, for example, 100 rupees earnings is increased to 110, right? And the number of shares 10 is increased or decreased, whatever, of course it will be increased only. So 10 suppose is increased, say, to 120, sorry, 10 increased to 15, right? Then 110 divided by 15, what would be the number? What would be the output?
7.33.
7.33, right? So here what is happening? My basic earning per share was rupees 10 and my diluted earning per share is 7.33. So it means my earning per share is getting reduced, correct? After the dilution effect?
Yes.
Yes or no?
Yes.
Yes. So in this case, this is the diluted earning per share. But what if my earnings were, say, increased or decreased to, instead of 110, suppose it was increased to 160 and divide by 15, the same number of shares, right? What would be the output?
10.6.
10.6, right? So in this case, my diluted earning per share is increasing as compared to the basic earning per share, right? So here the standard has the limitation. So standard says it is not actually a dilution. It is an anti-dilution, right? Because my diluted earning per share is coming higher as compared to the basic earning per share, right? So it is not dilution, it is anti-dilution, right? So that's why these are the two definitions given by the standard. So standard says dilution is the reduction in earnings per share, correct? Not the absolute. Reduction in earnings per share or increase in loss per share. Is that clear? So let me take an example of the increase in loss as well. So for example, A Limited was having a loss of rupees 100, right? And they had the share capital number of shares 10. So what was the basic earning per share? Minus 10, correct? Minus 10.
Yes.
Now, after converting, the options, warrants, or convertible debentures, bonds, or shares, the earnings, are, say, suppose, uh, become minus 80, right? So instead of 100 loss, the loss becomes 80, right? And this 10 becomes, say, 12, right? Number of shares because of addition of the potential shares, right? What would be the output?
Minus 6.67.
Minus 6.67. Now, my basic earning per share was 10 rupees minus. My diluted earning per share is minus 6.67. How many of you believe that this is dilution or this is anti-dilution?
Anti-dilution.
Anti-dilution? Any other thoughts?
Dilution.
Dilution? So, dilution will be there when the loss per share is increased. Loss per share is increased. Now, loss per share 10 rupees is higher or loss per share 6 rupees is higher.
Yes, it is anti-dilution.
Clear to everybody what I'm trying
Clear.
to say? So, dilution means when the company is profitable, then the dilution means that profit per share is getting reduced. And when the company is into the losses, the loss per share is getting increased. So this is called dilution, right? And the opposite of this is anti-dilution. Anybody has doubts on this?
So why is the profits changing because of this?
So why the profit is changing, right? So there could be the two questions. Why the numerator, that is the earnings per share is earnings attributable to equity shareholders is changing, and why the number of shares is also changing in the denominator, right? So these are the two questions as of now. But I will answer these. But are we clear on the concept of dilution and anti-dilution? Is there any confusion?
Clear.
Right? So dilution means either the profits are reduced or the loss is increased, right? And opposite of this is the anti-dilution. Now, the question, why numerator and denominator are getting changed, right? So, when we convert the convertible preference shares, right, into the equity shares, right? So, convertible preference shares are getting converted into equity shares now. So, they are not getting converted per se, but for the purpose of calculation of basic earning per share and diluted earning per share, we are assuming that if these shares are converted, what would be the number of equity shares? So when I say 100 preference shares will be converted into 200 equity shares, and my original base is say 1000 equity shares, then how many equity shares eventually I will end up after the conversion? So this is numerator and this is denominator, right? So first of all, I'm talking about denominator. So I have 1000 equity shares as of now plus 200 potential ordinary shares, right? potential ordinary shares, which is nothing but convertible preference share capital. Okay. So if I convert the preference shares, it will result into 200 additional ordinary shares. Then if these are converted, what would be my denominator?
It's 1,200.
1200, right? So denominator is understood. Why denominator is getting changed? Right? I'm not saying that I'm actually taking an action to convert the preference shares into the equity shares. No, I'm not converting them. But I'm assuming if they are converted, what would be my new number of equity shares? So that would be 1200. Is that clear?
Clear.
Now let's come to the numerator now. So this is my denominator, and numerator was earnings attributable to equity shareholders, right? Suppose this number was 15,000, right? Then plus or minus, right? Because adjustment could be either way. Now, because I'm converting my preference shares into equity shares, so post conversion, whether I will be having a liability to pay the dividend on those preference shares?
No.
No, because they are already converted now, right? My assumption is right. So if they are converted, there wouldn't be any further dividend for those preference shares. So, but until conversion, I am paying that dividend, yes or no?
Yes.
Right? So that dividend which I am paying as of now, right, which will eventually be waived off post conversion. So it does that mean that in today's scenario, when these are not converted, my earnings attributable to equity shareholder is calculated after the deduction of that dividend? Yes or no?
Yes.
Yes. So if I convert those preference shares, then since I wouldn't be required to pay those dividends, so those dividends will no more be deducted
Right.
from my earnings attributable to shareholders. So what I will do eventually, I will add that that dividend component of those preference shares, which I had deducted originally in arriving at the equity earnings available to equity shareholders. Suppose these were the 10% and the amount of these dividends on these preference shares was, say, suppose 2000, for example, right? So 2000 was the amount of dividend which eventually I had deducted while calculating the earnings attributable to equity shareholders. So what I will do, I will add that back. Yes or no?
Yes, that will be added back.
Right? So 15,000 plus 2,000. How much is the number now? 17,000. Right? So that's why this is changing for the purpose of calculation of diluted earning per share, right? So when I go and calculate the diluted earning per share, then I need to take the base of earnings available to equity shareholders, which I have used in my calculation of basic earning per share. And in that earning, I need to do certain adjustments for the numerator in order to arrive at the new or revised earnings available to the revised number of ordinary shares holders, correct? And similarly, divided by the revised number of shares, ordinary shares. And that's the same concept which we have studied under the IGAP as well. Nothing different we are talking about today, correct? Yes or no?
Yes.
Any further question anybody has? Okay. Now, EPS measures. So, as I mentioned, EPS are of two types: basic earning per share and the diluted earning per share. We will do certainly lots of numericals as well before we complete this standard. We will be mastering this concepts. basic earning per share, EPS for earnings from continuing, EPS for earnings from discontinuing, and EPS for net earnings. Then similarly, diluted earning per share for continuing, for discontinuing, and for net. Right? So, what do you mean by continuing operations and discontinued operations? India's 105 already done in this batch?
Yes, done.
Non-current assets held for sale and discontinued operations.
Yes,
Right?
done.
So, what we studied in that standard? Let's do a quick recap. So, what are the key, uh, you know, things which the standard has brought in terms of accounting and presentation of our financial statements in case the company has discontinuing operations? And first of all, what is the discontinuing operations? What is discontinued operation?
These have to be shown separately
Hmm.
in the profit and loss,
Hmm.
profit or loss from discontinued operations.
Hmm. Okay. So whenever the company has any product line, business line, right, or any other, you know, uh, operations which they are discontinuing or discontinued during the year, then 105 requires two things. Number one, the valuation of that business at fair value less cost to sell, right? Are you able to recall that was the valuation measurement?
Yes,
Fair value less cost to sell. And in terms of presentation, the standard says 105 that they need to be presented separately as a separate line item on the face of the P&L, right? As well as on the face of the balance sheet. Correct? Non-current assets held for sale and discontinued operations XXX assets and liabilities in the balance sheet also on the face separately presented, and in the P&L as well. Profit from continuing operations, profit from discontinuing operations, total profit, right? Are you able to recall this presentation requirements?
yes,
Right? So when we are presenting profits from continuing operations, profits from discontinued operations, and the total profits, right, in our financial statements, because we have some businesses as discontinued, then this Ind AS 33 says because you are having a discontinued operation as well alongside of some continuing operations, and you have profits from continuing and profits from discontinuing, or loss from continuing, profit from discontinuing, or profit from continuing or loss from discontinuing, right? Either possible scenario, right? One continuing may have profit or loss, discontinuing may also have profit or loss, or any combination, right? So this standard says, boss, because we want to make in users of the financial statements understand your performance in a better way. So instead of disclosing one earning per share that is basis on the overall profits, right, it will not tantamount to the right information made available to them. So let's do one thing, because you have continuing operations as well as discontinuing operations. So let's do the EPS disclosure as well aligned with that. So this standard says, first of all, you need to calculate the basic earning per share for continuing operations, then calculate the basic earning per share for discontinued operations, and then calculate the basic earning per share for total earnings or net earnings. Similarly, if you have any potential ordinary shares as well, then calculate basic earning per share for, oh sorry, diluted earning per share for continuing operations, diluted earning per share for discontinued operations, and diluted earning per share for total earnings. Clear?
clear.
Right? So we will do the calculations. Don't worry. Then basic earning per share, what is the formula finally? Because at the end of the day, we need to understand the formula in order to arrive at. So the formula given by the standard is earning per share, that is the net profit or loss after tax, after deduction of non-controlling interest, and after deducting of all the preference share dividends or any other similar items. This would be regarded as earnings attributable to ordinary shareholders. Earnings attributable to ordinary shareholders, right? So this is what we need to calculate first. We cannot divide simply the profit coming in the P&L divided by the number of shares. No, net profit as uh, uh, appearing in the P&L is not the right number to calculate the basic earning per share or diluted, right? First of all, we need to calculate the earnings attributable to the ordinary shareholders, and then divide those earnings divide by average number of shares on the opening date of the financial year or average number of shares on the closing date of the financial year. What do you think? Weighted average number of shares, right? So neither the opening nor the closing. What the standard says, weighted average number of ordinary shares outstanding during the period, not at the end of the period, during the period, right? So for the entire year from 1st of April till 31st March, if we are preparing the financial statements annually, then for the entire year, what was my opening number of ordinary shares? What are the shares which I have issued during the period? How many shares I have bought back and cancelled during the period? And then finally, what is the closing? So I need to calculate the weighted average number of shares outstanding during the period by applying weights on the basis of number of days. Correct? So how many shares were actually outstanding for how many number of days during the year or the period for which we are calculating the EPS measurement? We need to calculate weighted average number of shares, right? So same concept which we have been studying under the IGAP and doing under the IGAP, nothing different. We used to calculate the weighted average number of ordinary shares there as well. Yes or no?
Yes.
Right? Now, so in this formula, there are two items which we need to calculate first. First is the numerator. Numerator is earnings available for ordinary shareholders. And the second item is the denominator, that is the weighted average number of ordinary shares outstanding during the period, right? So once we calculate both these items, we will be able to calculate the EPS. Now, what numerator means, how numerator will be calculated? So numerator needs to be calculated like profits taken from the P&L. So profit or loss from continuing operations attributable to the parent entity is adjusted for. So in this case, continuing operations word is written. So it means first of all, we are calculating for continuing operations, right? Then what adjustments we are making? After tax amounts of the preference share capital dividends, right? So if the dividends are paid, what are the after tax amounts? So what is the tax rate of the company? Tax rate adjustment I will make on the preference dividend amount, and then I will adjust. Then difference arising on the settlement of the preference shares. So if any preference shares are either converted during the year or repaid during the year, right? So, whatever the settlement gain or loss which the company has booked on the settlement of those preference shares during the year, so that difference is also needs to be adjusted here. Then, other similar effects of the preference shares which are classified as equity. Now, because financial instruments, Ind AS 32, Ind AS 109, Ind AS 107 is not yet done in this batch. So let me give you a quick flavor of financial instrument first before we further proceed, because that is very important to understand what is the impact uh, in the Indias, which is different as compared to the IGAP. So in IGAP, whenever a company had a preference share capital, so where those preference share capital were presented and how that preference share capital was accounted for. Anybody? I'm talking about IGAP. In IGAP, what is the accounting of preference share capital? Are you able to recall how you were accounting for preference share capital in the IGAP financials? No? So in IGAP, preference share capital was presented as a preference share capital only in the balance sheet. And whatever the dividends which were to be paid to the preference shareholders, if they were cumulative, they were recorded as a liability and accumulated. And if they were non-cumulative, then the liability recording depends on the declaration. So if the dividends were declared, then the liability was recorded. If the dividends were not declared, then the liability was not recorded because of non-cumulative in nature, right? What do you mean by cumulative and non-cumulative?
In cumulative, the preference dividends gets cumulated and can be paid afterwards. In non-cumulative, it gets lapsed
Right.
if not paid.
So, correct, very appropriate. So, cumulative preference shares means if dividends are not paid, they will be continued to accrued and they will form the liability and they needs to be discharged at some date, right? So until discharged or until paid by the company, they will keep on accumulating as a liability in the balance sheet, right? Even if declared or not, right? Because they are cumulative preference shares, so it is assumed that dividend is the liability of the company. They will be paid anyway, right? Whether today or tomorrow. But in case of non-cumulative preference shares, non-cumulative means that dividends, if not declared, will not accrue, right? So dividends will accrue only when declared. So suppose if for year 2022, dividend was declared but not paid, then it will be recorded as liability. For 2023, dividend was not declared, then no liability will be recorded for that year for the preference shares. Then in 2024, again dividends were not declared by the company on preference shares, then no liability will be accrued or recorded, right? Then in 2025, again the company declared the dividend. Then 2022 liability and 2025 liability are the only two liabilities in the books of the accounts of the company if they are not yet paid. Is that correct? That's what cumulative, non-cumulative means. Correct?
Yes.
So under India's, the accounting is different. So this was the accounting under the IGAP, which we were talking about. Now under India's, any idea what is the accounting for preference shares? Although I know financial instruments chapter is not yet done, but still, any guesses? Anybody? No idea? Okay. So under the India's financial instrument India's 32, India's 109, right? These are the two standards governing the accounting and presentation of the financial instruments. And India's 107 is the standard which talks about all the disclosures required for the financial instruments, right? So these are the three standards. The set of these three standards is called the financial instruments standards, right? Now, India's 32, the definition which we have just studied, says equity share is a instrument for which entitles the residual interest in the assets of the company, right? But India's 32 doesn't define the preference share capital, right? So in the eyes of India's, there is no preference shares. So India says preference share, we do not know what preference share means. So standard says, or India says, preference share is either a equity or a liability only, right? So we will not call preference shares as preference shares. We will not give any special accounting treatment or special presentation requirements. So in IGAP, we used to present equity share capital, preference share capital on the balance sheet. But now in India's, you will not find anywhere preference share capital presentation, right? So standard says preference share capital needs to be accounted for basis on what the true color of this instrument is. So if the true color is like a bond or the debenture, then it will be a liability. And if the true color is like a ordinary share, then it will be an ordinary share. And if the true color is a mix and match of the debenture or bond and the ordinary share, then we will do the split accounting. So we will calculate the liability component and account for that component as a liability in our financial statements, and the remaining component, which is not the liability, will be recorded as the equity in the financial statements. But for sure, under India's financials, preference share capital will not be visible anywhere separately, right? So this is what the financial instruments topic will guide. Whenever you go and study the financial instruments and do the numericals, you will come to know how the liability component is separated from the total component of the preference share capital, and the leftover is accounted for as equity, right? In case the instrument finds a hybrid instrument. If the instrument is a clear liability instrument only, but the name is given as a preference share, then it will be completely a liability only, right? And accordingly, it will be presented as liabilities. And again, it will be divided into current, non-current, basis on the current, non-current feature, right? So that's how the preference shares are accounted for under NDS. So you will not find preference shares anywhere in the India's financials, right? Any item of income or expense which is otherwise required to be recognized in the profit or loss in accordance with India's debited or credited to securities premium account or other reserves. So although you will not find any such item, because if you find any such item, it will be a non-compliance with the Indias. So what this line says, that in case there is any other item of either in the nature of income or in the nature of expense, which is required to be recognized in the P&L by the Indias, but management did not record in the P&L, but either debited or credited it to some reserves, be it securities premium reserve or any other reserves by whatever name called, but didn't impact the P&L, then for the purpose of calculation of the earning per share, we will bring back that item and adjust to the earnings, right? But before we proceed, because Indias has a specific set of accounting guidelines for each and every income or expense related item, right? So there is no rarest possibility even that we will deviate from the accounting prescribed by the Indias, right? Because in that case it will be a non-compliance with the Indias, right? And non-compliance with the Indias means the financial statements are not prepared in accordance with Indias, right? At all. So those will not be regarded as India's financials, right? So the sensitivity of applying the Indias correctly is very high, right? So in case we miss on anything, our financials are not compliant with the Indias. Now even just to safeguard the EPS calculation, standard is still saying even if by any chance there is any item which was required to be recognized in the P&L as per the Indias, but management missed that or recorded it in any reserves, then it needs to be adjusted for the purpose of calculation of the earnings, right? So this is the numerator. After all these adjustments, whatever the number is arrived, that will be the final earnings available to the ordinary shareholders, right? And then we will talk about the denominator. What is the denominator? Weighted average number of shares, right? So simple. At least denominator is simple as compared to the numerator, right? We simply need to calculate the number of shares basis on the number of days they were outstanding during the year, right? So what the weighted average number of shares means? Ordinary shares outstanding at the beginning. So whatever is the opening share capital for the company, less any shares which are buyback during the period by the company. So those number of shares needs to be deducted. Add ordinary shares issued during the period. Now, ordinary shares issued during the period could be the private placement, could be the bonus issue, could be the right issue, right? Or could be the fresh issue, right? Any issue. So any shares which are issued by the company fresh during the period or the year, whether it is because of bonus issue or because of right issue or because of fresh issue or because of private placement to certain class of investors, right? All those will be added, and then whatever is the closing, that will be the weighted average number of shares. Now all these items, the opening, the bought back, and the new issues are weighted basis on the number of days, right? Right? From the date they are issued, from the date they are bought back till the closing date or the reporting date, how many days are there, they will be weighted, and this number is used as the denominator to arrive at the earning per share, right? So this is called the weighted average number of shares. We will do certain numericals, but let me come back to the main concept first. So numerator we have discussed. Now this is the chart which actually tells us how the preference shares dividends, discount on preference shares, premium on preference shares are to be adjusted for the purpose of calculation of the earning per share, right? Numerator part. So instead of starting with this chart, I'll start with the question. And once we are done with the question, we will study the chart, right? Other way around, I think it is better to understand. An entity has the following preference shares in issue at the end of 2004. 5% redeemable, non-cumulative. So please focus on these words: redeemable, non-cumulative preference shares. The shares are classified as liabilities. During the year, an amount of rupees 1 lakh computed using the coupon rate of 5%, rupees 20 lakh into my 5%, was paid to the preference shareholders. So this is the item number 1, right? Item number 2, increasing rate. Increasing rate, cumulative, non-redeemable preference shares issued at discount in 2000 with a cumulative dividend rate from 2005 of 10%. The shares were issued at a discount to compensate the shareholders because dividend payments will not commence until 2005. The accrual of the discount in the current year, calculated using the effective interest method, amounted to say 18,000 rupees, right? These shares are classified as equity, right? So standard question says that although this is the preference share capital, right? But this is classified as equity. What does this mean? This means this is not classified as liability, right? Under the Ind AS. So this is the second item. Third item, 8% non-redeemable, non-cumulative preference shares. At the beginning of the year, the entity had 1 lakh 8% preference shares outstanding, but at 30th June 2004, it repurchased 50,000 of these at a discount of rupees 1,000. So 1,000 is the discount at which the shares are repurchased, that is cancelled or bought back by the company. So 1,000 is the discount the company has earned by way of cancelling these preference shares, right? 7% cumulative convertible preference shares converted in the years. These shares were classified as equity until their conversion into ordinary shares at the beginning of the year. No dividend was accrued in respect of the year, although the previous year's dividend was paid immediately prior to the conversion. To induce the conversion, the terms of the conversion, the 7% convertible preference shares were also amended, and the revised terms entitled the preference shareholders an additional of 100 ordinary shares on the conversion with a fair value of 300 for a nil value. So we didn't ask preference shareholders to pay anything. Rather, we are issuing 100 ordinary shares of fair value 300 each at nil value. How much benefit we are passing on to the preference shareholders in that case? 100 into my 300, right? So it means how much is the value? 30,000, correct? So 30,000 is the additional value which we are passing on by amending the terms of the preference shareholders agreement, right? At the time of conversion. The profit after tax for the year 2004 is 1,50,000 as per the P&L, right? Determine the adjustments for the purpose of calculating the EPS, or rather calculate the numerator, right? So we need to calculate the numerator. What is the numerator? Numerator means earnings attributable to ordinary shareholders. Question is clear? Everybody was reading the question clearly and noting down the key facts on your writing pads for each of these four items. Should I start discussing the case by case answer, or you want to still read the question once again before I start? Maybe I can give you 2 minutes just to read the question yourself again, understand what are the terms and the facts for each of these four items, and then after 2 minutes I'll start discussing the solution, how adjustments will be made for each of these items. Keep your calculators ready and the notepad also ready. Okay, I hope everybody has noted down the key facts on their writing pad, right? Let's see how we are going to adjust these items. So profit after tax as given in the question as per the statement of profit and loss. How much? 1,50,000, right? So this is the first item to start with. So whatever the profit after tax is given to us in the question, 1,50,000, we'll start with that and we will adjust for these items and then we will reach to the number which will be regarded as earnings attributable to ordinary equity holders, right? For the purpose of calculation of EPS, right? We are not going to make these adjustments in our books of accounts. That's I have, you know, discussed and cleared at the very beginning. So whatever all these adjustments we are going to discuss, understand, and calculate, these are solely for the purpose of calculation of the earnings attributable to equity shareholders, right? They are not going to be adjusted or accounting for, right? So no JEs are being passed in the books. No adjustments are to be given in the balance sheet or the P&L, right? These are only in our working notes for the purpose of calculation of the numerator part for the EPS calculation, right? Now, first item, amortization of discount on issue of the increasing rate preference shares, 18,000, right? Let's get back to the fact. So this item we are talking about, second item first, right? So I will come to the first item later. So let's start with the second item first. Increasing rate cumulative. Cumulative means the dividends, whether declared or not, will be accumulated. Non-redeemable means the preference share capital is not redeemable, right? Although in India, as per the Companies Act, non-redeemable preference shares are not allowed to be issued, right? Do you know this fact or not?
Yes, no,
Right? It is not allowed, correct?
correct.
So, in India, as per the Companies Act 2013, non-redeemable preference share capital cannot be issued, right? But that is a legal aspect. So let's not confuse with that. For the purpose of our India's, if this is the term, okay, we will go with this. So cumulative means the dividends are accumulated even if not declared. Non-redeemable means preference shares will not be redeemed, right, by the company. And when these shares were issued, they were issued at a discount. So whenever the preference shares are issued at a discount, it means the company is benefiting or the preference shareholders is benefiting.
Preference shareholder is benefiting.
Preference shareholder will be benefiting. Now, because this benefit is flowing to a certain class of preference shareholders, does it mean that this benefit will reduce the overall profit of the company? Yes, no? Okay, so let me put this question to you in a different way. So there are two class of people, right? So there is the company A Limited and there are two class of people. Class 1 preference shareholders, class 2 equity shareholders, right? And company has earned during the year say 10,000 rupees as per the PNL. Now in this 10,000 rupees, preference share will holders will also participate and equity shareholders also wants to participate, correct? Yes or no?
Yes,
Correct. Now this 10,000 belongs to both preference shareholders as well as equity shareholders. Until now it is super simple, right? Now company says, let me issue some shares, preference shares to the preference shareholders at a discount. So shares worth rupees 100 are issued at rupees 80 to this class of people. Then the 20 rupees discount which is being offered by the company by virtue of this action to issue the preference shares at a discount, this 20 rupees out of that 10,000 profit is passed on to which class of people? The preference shareholders.
Yes.
So does it mean that this 20 rupees discount on each share is passed on to preference shareholders at the cost of equity shareholders? Yes or no?
Yes.
So let me take one more example, super simple example. So there is a cake, right? And the cake is fixed, 1 kg cake, right? And there are two parties who are going to eat that cake, right? Party A and party B. If the some portion of the cake is offered to party A even before starting the distribution of the entire cake, right? So that portion or the bite which is preferably offered to the party A means the overall cake size is reduced for the other party.
Yes.
Yes. So because this specific piece is preferably offered to a particular class of people, it means they are benefiting at the cost of the other party. Yes or no?
Yes.
Yes. Now, just keep this cake example and two parties in your mind, right? This happens, right? So, whenever cake is distributed, some people are getting the larger bite, some people are getting the smaller bite. So, can I say the people getting the larger bite is getting those additional cake at the cost of the other party who is getting the smaller bite? Yes or no?
Yes.
Yes. So keep this example in your mind throughout this calculation and you will nail all the concept, right? So this happens with pizza as well. So sometimes when pizza comes to us and there are four people in the family sitting and opening the box of the pizza. So everybody, looks which, slice is the larger in the size, right? So if somebody picks up the larger slice, it means they are picking the larger portion at the cost of the other person. Yes or no?
Yes. That's right.
Right? So let's now correlate this cake or pizza example with these facts. Now there are two class of people who are fighting with each other to grab the profits from the company, right? Because equity shareholders have purchased the equity shares and preference shareholders have purchased the preference shares. They are both the owners in that company, and whatever the profit the company is generating, they are fighting with each other to grab the highest possible share. But by virtue of preference shareholders having a preferable rights over those profits, they are getting paid off first, and whatever is the leftover will be passed on eventually to the equity shareholders. So that is the irony of the equity shareholders, right? Now, in this case, let me read the clause again. What is happening here? Increasing rate cumulative non-redeemable preference shares issued at a discount. So when I say shares were issued at a discount, it means the preference shareholders were given certain benefit at the cost of the equity shareholders.
Yes.
So can I say even before ordering the cake or before ordering the pizza, the person who is ordering, right, the pizza is also ordering a sides for himself without, telling the other party that he has ordered the sides as well along with the pizza. And as when the order is received, instead of getting the pizza distributed, the sides he has already grabbed at, very first as and when the order is received. So this is similar to the discount being offered at the very early date when these preference shares were holders were offered the preference shares, right? So at the very initial date itself, they were offered something even before the company has earned something. Are you getting my thought? Whatever I am trying to say.
Yes. Now clear. Yes.
Now clear? So the discount offered to preference shareholders is similar to the sides the person ordering the pizza getting the sides ordered for himself only, right? The sides, although the total order cost will be costing to the company, right? But in that total order cost, only the pizza is distributed. The sides are taken by this person only, and this person is the preference shareholder who is purchasing the preference shares at a discount at the inception date, right? So this discount is given to these preference shareholders at the cost of the equity shareholders. Is that clear now?
Clear.
Now, how much amount is pertaining to this cost? 18,000 given in the question. Yes or no?
Yes, 18,000. Yes.
18,000. So 18,000 is the benefit which had been passed to the preference shareholders on the very first day when the shareholders have actually become shareholders, preference shareholders, right? And what this 18,000 is? 18,000 is the discount amortized in accordance with Ind AS 109 financial instrument basis on the effective interest method. So this amortization or this calculation you will study under the Ind AS 109. For the sake of simplicity, this 18,000 computed amount is given in the question, right? Now, for the purpose of calculation of earnings attributable to equity shareholders, whatever is the profit of the company, say 10,000 minus, 1 lakh 50,000 minus 18,000 is the eventual leftover for the equity shareholder, because this 18,000 is grabbed by the preference shareholders, even before the profits could start distributed, right? So
Yes.
what we are doing, this 18,000 we are deducting from the overall profits of the company. So this profit belongs to both parties, preference share as well as equity shares. But because preference shares, got this 18,000 benefit before even the profits were earned by the company, so this 18,000 adjustment is to be made for the purpose of calculation of profits available for equity shareholders. So because 18,000 is paid off to the preference shareholders in the form of reduced price for purchasing preference shares, so this benefit which is passed from the company's pockets, and that pocket belonged to both preference shareholders and equity shareholders, so 18,000 is deducted for the purpose of calculation of the leftover for the equity shareholder, right? So this 18,000 is deducted here, right? And in the question it is very clearly said that the annual accrual of the discount in the current year calculated using the EIR. Now, when you go and study the financial instruments chapter, right, Ind AS 32 and 109, there you will see that we need to calculate the present value of all these preference share capital which are being accounted for, right, in terms of liability and equity component. And those present value, once calculated, are calculated at a particular discount rate, right? That particular discount rate is regarded as effective interest method, EIR, effective interest rate method, EIR method, right? So that EIR method you will study there, but assuming this is given in the question that 18,000 pertains to 1 year. So 18,000 is not the total discount offered to the preference shareholders. It could be 1 lakh, it could be 2 lakhs, it could be 50,000, something else. But 18,000 is what? The annual EIR calculated amount for the financial year, right? So we are calculating earning per share for a financial year, yes or no?
Yes.
Right? And we are taking the profits for the financial year, yes or no? 1,50,000, yes. Then whatever the adjustments we are going to make should also be apple to apple. So it should be the total discount given to the preference shareholders, which is amortized over the life of the preference shares, or it should be the amount which is getting amortized in this financial year should be considered. What do you think?
The amount that should be amortized this year.
This year, right? So this year profit minus the cost which is being amortized as per Ind AS 109 for this discount given to preference shareholders at EIR for this year, that is 18,000 given in the question, right? So 18,000 is given to the preference shareholders at the cost of the equity shareholder, and hence 18,000 is reducing the overall profits available for equity shareholders, and hence we are deducting it. Until now, everything is clear,
Clear.
right? Let's go to the third item. 8% non-redeemable, non-cumulative. So non-cumulative means dividends are not getting accrued, right? At the beginning of the year, the entity had 1,08% preference shares outstanding, but on 30th June 2004, it repurchased 50,000 of these at a discount of rupees 1,000. Now, what is happening in this case? The company during the year is purchasing 50,000 shares back from the preference shareholders at a discount of rupees 1,000. So ideally, they would have paid 1,000 more to the preference shareholders, but they negotiated better and saved 1,000. So it means they saved 1,000 rupees for whom? The next owners, because this 1,000 otherwise would have been paid to the preference shareholders had the company redeemed the preference shares at the fair value. But because company management negotiated with the preference shareholders in a better way, and they eventually end up buying the preference shares worth rupees lakh at rupees 99,000 during the year. So eventually they saved rupees 1,000 cash outflow on this transaction, or 1,000 expense outflow on this transaction. Then because something is saved from the preference shareholders, then to whom it will belong finally?
To the company.
Of course, to the company, but to the owners of the company. And who are the owners? Finally, owners, the equity shareholders,
Shareholders, yes.
right? So for the purpose of calculation of earnings attributable to the equity shareholders, should I add this 1,000 now?
Yes.
Right? So this is a similar situation where when everybody was picking up the pizza slice, and suddenly you notice that the other person is taking the higher bite, and you suddenly stopped and replaced the bite, right? So when the pizza slice is replaced, so the larger slice coming back from the preference shareholders to the equity shareholders. So similarly, 1,000 which otherwise would have been paid to the preference shareholders now saved. So something saved from the preference shareholders will eventually be available for whom? Equity shareholders.
Yes.
Correct. So similar notion. So what is the rule coming out of all this discussion? So this discussion is, if there are two types of owners, right? So if somebody is getting benefited, then the other will be eventually paid less. If somebody is getting the cost, then other will be benefited, right? So in the first case, we were giving a discount to the preference shareholders of rupees 18,000. So 18,000 was reducing the profits for the next best owner, equity shareholders. But in the second case, we bought back the preference shares at a discount, so we saved rupees 1,000. So that 1,000 will now belong to the equity shareholders. So that's why we are adding it back, right? So 1,000 we are now adding back, right? Third, 7% cumulative convertible preference shares converted in the year. These shares were classified as equity until their conversion into the ordinary shares at the beginning of the year. No dividend was accrued in respect of the year, although the previous year's dividends were paid immediately prior to the conversion. To induce the conversion, the terms of the conversion were amended, right? And basis on the revised terms, the preference shareholders are entitled additional equity shares worth rupees 30,000. So 100 ordinary shares 300 rupees each. So 30,000 additional worth of equity shares is being given to the preference shareholders. So it means these additional shares which are being given to the preference shareholders, right, by amending the terms, are at the cost of the equity shareholders. Yes or no?
Yes.
Right? So again, we will deduct this 30,000. So what is this? This is nothing but a premium to convert preference shareholders. So management went to the preference shareholders and said, boss, do you want to convert? Then preference shareholder said, are you giving something extra to convince us to convert? So management said, okay, we will give you a 30,000 voucher, right? And that 30,000 voucher could be in the shape of cash, could be in the shape of Amazon voucher, could be in the shape of the additional equity shares, right? Whatever name called. So 30,000 is the cost for the company, right? Preference shareholders agreed. They received the voucher of 30,000 and get their shares converted, right? So this 30,000 is what? Expense for the company, and something which is expensed for the company, and that expense is hitting the P&L now, will eventually reduce the uh, benefits available for the equity shareholders ultimately, right? So again, this 30,000 is deducted. So this total of these three adjustments is 47,000 negative. So 150 minus 47, 1,03,000. So finally, the earnings, although the company had profit as per the P&L 1,50,000, but for the purpose of calculation of earning per share, the profit is not 1,50,000, but it is the profit available for the ordinary shareholders, that is 1,03,000. So 1,03,000 divided by the weighted average number of shares. Is that clear?
Clear, but what does it mean by saying increasing rate preference shares?
Increasing rate preference shares. So increasing rate preference shares means I am issuing a preference shares at a coupon rate of say 3% today, right? And as per the terms of the preference shareholders agreement between the company and the shareholders, preference shareholders, it is agreed that every 3 years, 1% dividend will be increased. So, for example, 3% in 2022, right? When the agreement was originally entered. So, 2022, 3%, and 1% will be added every 3 years. So next addition will happen in 2024, 5. It will be 3% plus 1%, 4% now. Then again 2028, it will be 5%. Then again 2031, right? It will be 6% and like that. So increasing rate means after certain number of years, it may be annually, it may be biannually, it may be in a 3 years, it may be in a 5 years, right? Or it may be on some other period, right? If a rate of dividend, coupon rate of dividend is increased for the preference shareholders over the period, so that those type of preference shares are called increasing rate preference shares. So this is nothing but a feature to make the offer lucrative for the investors to invest in the company, right? So the company says, because we are a smaller company today, we cannot commit say 10% coupon rate, so let's start with 5% and we will increase gradually as and when we become more profitable. So shareholders also agreed. So they started with 5%, and every year they are increasing 1% until they reach 10%, right? So 5%, 6%, 7%, 8%, 9%, 10%. And then at 10%, they will stop increasing. So this is called the increasing rate preference shares. Is that clear?
Yes, got it. Clear.
Clear? Now, whatever we have discussed in this solution, okay, one item is left, right? I said that I will discuss it at last. So these three items I have already discussed, and now you have understood how these adjustments are taken care. Now, the first item, 5% redeemable, non-cumulative preference shares. These shares are classified as liabilities. So when something is classified as liability, right? Then how many of you believe that interest on those liabilities is already charged in the P&L? So while preparing the financial statements, do we record interest on debentures as expense?
Yes.
Right. So when we record interest on loans, interest on debentures, interest on bonds as an expense and then arrive at the P&L, right? Profit for the
Yes.
year. So if preference shares under Ind AS, I told under Ind AS 32 and 109, preference shares either could be a liability or could be a equity or could be both, right? So if it is a liability, then instead of dividend, we call interest. If it is a equity, we will say it is not a preference share capital, it is a equity only, right? And if it is both, then the component we will divide basis on the present value for the liability component, and interest will be calculated thereon and charged to the P&L. So in the first item, because question says these type of reference shares 5% redeemable non-cumulative are actually a liability only for the company. So because this is a liability only for the company in the eyes of Ind AS, so they must have been accounted for as liability only, and because they have accounted for as liability, so interest on those liabilities have already been taken care in the P&L. So this 1,50,000 which is given in the question profit as per the P&L is already arrived after charging interest on all the liabilities, right?
Yes.
Including this one, because this one is also liability, right? So that's why there is no further adjustments required to be made for the liabilities, right? All the notes which we have discussed are here, right? For your future reference,
It is
right?
already reflected in profit after tax. So
Correct,
there
correct.
is
It
no
is
adjustment.
already reflected in profit after tax, correct? So this was the question, and I hope the concept of arriving at the earnings attributable to ordinary shareholders is now clear to everybody, right? How we are thinking while making these adjustments, right? Always remember the example of the cake and the pizza, and you will be able to, pick up the right conclusion, right? Okay. So whatever we have discussed through this question, whatever the concepts, all those concepts are defined in words by the standard, right? And those words in the Bear Act are typical to understand. That's why they are put it here in this chart form in easy to understand language so that you can remember the concept or revise the concept easily, right? So I think let's have a break. You have some relax, and then we will study this chart. And again, we will correlate this chart concept with the practical aspects we have just understood through the example after we come back from the break. So let's have a 10 minutes break. We will return at 9 o'clock sharp, right? It's 8:47, so 9 o'clock sharp. Fine.
Okay.
Break started, Ashokji. So I hope you enjoyed the tea, coffees in the break, and now back with fresh mind and energy. So what we were talking before the break is the practical which we did around various types of benefits being passed on to the preference shareholders, right? And when I say that if something is being given to preference shareholders, it is being given at the cost of equity shareholders or the ordinary shareholders, right? So it will reduce the earnings available for equity shareholders, right? And that's what the calculation we are doing for the purpose of calculation of EPS, because EPS is calculated earnings per share and share is the equity share. So that's why earnings we need to calculate first, which is truly available for the equity shareholders out of the total profits of the company, right? So total profits minus anything to be given to the preference shareholders, and rest portion will be used for equity shareholders. That's why this numerator is to be calculated first, right? Now, how all these adjustments are reflected or taken care, that we have understood through the example, but now we will see how these are explained in the standard, right? How the standard actually uh, explains these treatment of after tax amount of the preference dividend in the calculation of basic earning per share, right? Now, nature of preference shares. There are two types of preference shares, non cumulative and cumulative, right? So first of all we will talk about non cumulative. So for non cumulative, what does it mean? It means unless and until the dividends are declared, they will not be accrued, right? So dividends will be accrued only when declared, right? To put it other way around, correct? So in this case, as and when dividends are declared, then only this dividend will be accrued as liability. And since this will be given to the preference shareholders, so it will reduce the earnings available for equity shareholders. So standard says deduct after tax amount of preference dividend for the period from the P&L only when declared, right? So if declared, then only this adjustment is required. Otherwise, no adjustment required for non-cumulative. For cumulative, irrespective of whether the company is declaring the dividend on preference shares or not, we will deduct. So standard says deduct after tax amount of preference dividend from profit and loss whether or not dividend is declared. So one thing is clear, that for any preference shares, whatever the dividend which needs to be paid to the preference shareholders is paid at the cost of the equity shareholders. Hence, it will be reduced from the earnings attributable to equity shareholders, right? Until now, it is simple. Then because preference share can be of two types, non-cumulative and cumulative. So for non-cumulative, this deduction will happen only when these dividends are declared, and for cumulative, irrespective of this declaration, dividends will be deducted. Now one more aspect, standard says post tax, right? After tax, what do you mean by that? After tax amount, what is after tax amount?
Profit after all the expenses and the tax, depreciation, everything.
Mhm. So after tax amount of preference dividend, after tax amount of preference dividend, what does that mean? After tax amount of preference dividend, after tax amount of preference dividend, what does that mean?
That could be meaning profit after tax, but before preference dividend.
Mhm. No. So when we prepare the financial statements, so when we prepare the financial statements, so our financial statements, are starting with say revenue, right? Then all expenses, right? And then we arrive at the profit. Correct? Right?
Yes.
Then on this profit, basis on the income tax computation, we deduct the tax, right?
Yes.
And then this is coming as net profit after tax. Correct?
Yes.
Correct? And this net profit after tax is available for whom? Towards the owners of the company.
Yes.
Who are
And
the
this
owners?
preference
Who are the owners? Two
equity
types of
shareholders
owners: preference
and
and equity.
preference shareholders. Yes.
Preference and equity, correct?
Yes.
Because for preference shareholders, dividend is not an amount expense which is already charged under the expense, so that we charge now, right,
Yes.
in order to calculate the earnings available for equity shareholders. But
Yes.
this was IGAP. But under Ind-AS, what is happening? Under Ind-AS, Ind-AS says, boss, there is no preference shares, right? There is no concept of preference shares. Either it will be a liability or it will be a equity, correct?
Yes.
So if it is a liability, then instead of dividend, whether I can say interest.
Yes.
So
And
if
that
I
will be
say
reflected.
interest on liability, then it is my finance cost.
Yes.
Finance cost is reflected where? Before the
Before.
arriving out at the profits,
Yes. Before profit. After tax.
right? Before profits. So if I deduct finance cost from my revenues in order to arrive at profits, then finance cost is allowing me a deduction for the purpose of calculation of tax. So it is saving some portion of tax otherwise which would have been paid by the company, because it is one of the expense being deductible,
Yes.
right? So on finance cost, tax adjustment has to be calculated. So let me take an example. Suppose there is a 10% coupon rate on preference share capital of rupees 1 lakh, right? Then how much is the dividend amount which company needs to pay?
10,000.
10,000, right? If this 10,000 is paid in the form of dividends, whether it is a allowable expense? No, right? This is a benefit paid to the owners, right? So 10,000 is not a allowable expense for taxation purposes, right? But when it is treated as a liability, it will be given the nature or color of interest,
Yes.
right? So on this 10,000, if tax rate is 30%, then how much would be the tax?
3,000.
3,000. Now, the total expense for the company would be 13,000 or 7,000?
7,000.
7,000. Now, it means that by virtue of paying 10,000 in the form of dividends within the nature of interest, 3,000 would be saved on taxes, correct? And because 3,000 would be saved on taxes, so net outflow would be how much? 7,000.
Yes.
Yes or no? So 7,000 would be adjusted in order to compute the earnings available for ordinary equity shareholders or ordinary shareholders, right? Because at the end of the day, it is a 7,000 cost which would be hitting the profits, because 3,000 is being saved in the form of reduced taxes, right? So although the preference shareholders are getting 10,000 only, right? I am not changing the amount which I am paying to the preference shareholders. I am giving them 10,000, but because on this 10,000, 30% tax is being saved, right? So 7,000 is eventually the hit to the equity shareholders, correct?
Yes.
So that's why the standard says when preference shares are non-cumulative or cumulative, right? So non-cumulative dividends are considered only when declared, but it should be post-tax or after-tax amount, right? And same for cumulative, because cumulative for anyway we are going to accrue the dividends, and hence post-tax adjustment needs to be made, right? So we will do the numericals, but from concept perspective, it is clear to everybody? Any doubts? Any questions?
No, clear for me.
Perfect. Thank you for the confirmation, Leela, as well in the chats. Now, apart from dividend, there could be certain other additional items which the company can give to the preference shareholders. What could be that? It could be a discount on the issuance, right? Or premium on the issuance, or discount on the redemption, or premium on the redemption. Yes or no? Any combination? So, whenever discount is offered at the time of issuance of preference shareholders, it means discount is offered to preference shareholders at the cost of equity shareholders, correct?
Yes, yes,
And if premium is charged from preference shareholders at the time of issuance, then it means it is a benefit for equity shareholders,
yes, benefit.
right? So if the discount is given, it will reduce the earnings available for equity shareholders. And if the premium is charged from the preference shareholders, then it will increase the earnings available for equity shareholders, right?
Yes, right.
So in both the cases, it will impact my earnings available for equity shareholders. So that's why I need to look after for these adjustments as well. So either it can happen at the time of discount issuance, or this discount or premium can also happen at the time of
Redemption,
conversion, conversion or
conversion.
redemption,
Yes,
conversion or redemption, or it can happen at both the instances, as at the time of issuance as well as at the time of conversion or redemption. Possible, not possible?
yes, possible.
Possible. Now, because this discount or this premium, whenever offered or charged from the preference shareholders, either at the time of issuance, or during the tenure, or at the time of redemption or conversion, it will certainly impact the earnings available for equity shareholders. That is the short thing which we have understood by now. Clear?
Clear.
Now, when shares are issued at discount or premium to provide for a low initial high dividend respectively to compensate the entity for settling the preference shares, selling the preference shares at a discount premium referred to as increasing rate preference shares. So rest all is a story, right? So we are not bothered why this discount or premium was offered or charged. The only thing is, if there is a discount or premium offered or charged, then it needs to be adjusted, right? Now, what the adjustment is required? Any original issue, discount or premium on increasing rate preference share is amortized to retained earnings using the effective interest rate method and treated as a preference dividend. So what the standard is saying? So standard is saying that whenever the company offers any discount to the preference shareholders at the time of issuance, right? Or charge any premium from the preference shareholders at the time of issuance of preference shares. So this discount or premium is nothing but should be treated as a benefit given or benefit received from the preference shareholders. And this benefit given or this benefit received, can I rename this benefit word by the word dividend?
Yes,
So can I say whatever benefit I am giving to the preference shareholders is a dividend only?
yes,
I can say that, right? So it's not about that dividend is the annual coupon rate only. Dividend means anything which is paid in return on the preference shareholders on their investment, be it in the form of discount at the issuance, or premium at the redemption, or dividends year on year basis at some coupon rate, right? So by whatever name called, whatever benefit is being passed on to the preference shareholders is a dividend. Can I say this now?
yes,
right? Now, once I establish that this is a dividend, then whatever the dividend I am paying off to the preference shareholders needs to be deducted from the earnings attributable to equity shareholders, right?
Yes, right.
So that's what the standard is saying. So standard says when preference shares are issued at a discount or premium to provide for a low or initial high dividend. So for whatever reason, if we are giving a discount or a redemption, doing a redemption at premium, it means we are benefiting the preference shareholders. So that benefit will tantamount to the dividend only, and that dividend needs to be adjusted. That's what the standard is saying, right? So other adjustments to the profit and loss attributable to the parent entity or equity shareholders, right? Then, when preference shares are repurchased under an entity's tender to tender offer to the holders, so even before the maturity, can the company go ahead and ask preference shareholders to return their preference shares for a consideration? Yes, of course, company can offer. So, in order to convince preference shareholders that they actually exercise the option, company has to come with some lucrative offer which otherwise wouldn't have been there at the maturity, right? So, making the offer to redeem preference shares now, right? This offer should be better as compared to what the preference shareholders would be getting at the time of maturity. Then only the preference shareholders will be convinced,
Yes, right.
right? So because we are making some offer which was not there under the original shareholders agreement at the time of issuance, and now because we are making this offer, so we have to give something additional over and above what was agreed in the agreement at the time of issuance. So this additional will be a benefit again to the preference shareholders,
Yes,
and because this benefit we are passing on, it will be passed on at the cost of whom? The equity shareholders.
right. Yes,
Correct. So again, what the standard says, any return, any return to the preference shareholders, that is charged to the retained earnings, deducted in calculating the profit and loss attributable to the equity, ordinary equity shareholders of the parent entity, would be equal to what? Fair value of the consideration paid to the preference shareholders minus carrying amount of the preference shares on the date of early conversion. So, on the date of this early offer, right before maturity, on the offer, what was the carrying amount of the preference shares and what amount I am offering to preference shares? Suppose the carrying amount of the preference shares was rupees 10,580 rupees, for example, including the cumulative dividends until that date, right? And I asked preference shares. So 10,580. So instead of 10,580, if I give you 12,000, will you be, handing over all your preference shares to me? So preference shareholders agreed, right? Because they are getting something additional over and above what they are entitled to as per the existing shareholders agreement, correct? So because this additional I am offering, so how much this additional would be needs to be computed by what formula? The amount which I am offering now, that is 12,000, minus the amount which is sitting in my books of accounts on this date, which is 10,580 rupees, right? Including the cumulative dividends, right? So what would be this additional amount? I think this much, correct?
yes, 1420. Yes,
Right? So this is the additional amount I am offering to the preference shareholders. Now, this is offered from whose pocket?
equity shareholders.
Equity shareholders. So I will reduce 1420 from the profit after tax as per the P&L for the year in which this offer is made. Correct?
Correct.
Third case, instead of redemption, there could be a possibility of conversion.
Yes.
So it is not always about redemption. It can be conversion as well. So the preference shares, which otherwise would have been convertible after 10 years, I am going to the preference shareholders and asking them, okay, I have a lucrative offer for you guys. If you wait till maturity, you will get one equity share for, say, one preference shares as per the original conversion terms. But if you opt to convert now, I will give you two equity shares for one preference shares. Possible, not possible?
Yes. Possible.
Possible. Now, because company is offering some additional benefits again to make the preference shareholders convinced to convert their preference share capital into equity share capital now instead of waiting for next 5 years down the line. So this additional benefit, whatever I am passing on, is again uh, getting passed on at the cost of whose pocket? Equity shareholders,
Equity. Yes.
right? So again, the standard says return to the preference shareholders charged to the redundant deducted in calculating the profit and loss attributable to equity shareholders or the parent entity will be equivalent to the fair value of the ordinary shares or other consideration paid at the time of conversion minus fair value of the consideration issuable under the original conversion terms, right? So as per the original terms, how much shares I was giving? One share. Now I am giving two shares, right? So the fair value which I am offering now, that is the fair value of the two shares on today's date minus the fair value of one share as per the original conversion terms, would be the additional benefit which I am passing on to the preference shareholders to make them act fast and convert their preference shares now instead of waiting for next 5 years, right? So by large, what is the thumb rule coming out of this whole chart? So instead of getting into these, discount, preference, dividend, non-cumulative, cumulative, the final outcome is one liner. That one line is whatever additional is being given to the preference shareholders by whatever name called will be deducted from the earnings attributable to the equity shareholders for the purpose of calculation of earning per share, right? So I am not going to say that whatever these adjustments are, you need to pass the journal entries in your books of accounts or you make the amendments in your P&L or the balance sheet. No, we are not altering or impacting neither the P&L nor the balance sheet, right? So that balance sheet P&L is already prepared. Only what we are doing, we are calculating the earning per share, and for the purpose of calculating earning per share, this standard says that you need to calculate the earnings attributable to equity shareholders first, right? Instead of dividing the whole profit divided by number of shares, you need to come out with the whatever the true profits available to equity shareholders out of the total net profits, right? And between that net profit to profit available to or earnings available to equity shareholders journey, these are adjustments which I am making in my workings only for the purpose of this calculation. These are not going to be accounted for anyway in my books of accounts. I hope this is now ultra clear to everybody,
Clear. Very much clear.
right? Note the amount of preference dividends for the period does not include the amount of any preference dividends for cumulative preference shares paid or declared during the current period in respect of the previous periods. So, are we calculating the EPS for the current year or we are calculating the EPS for cumulative 5-year period?
Current period only.
Current period. So, if we are preparing the quarterly results, so earnings or profit will be taken for the quarter, yes or no?
Yes.
Right? Similarly for half year, similar for year, right? So standard says the period for which the earning per share is calculated, right? For the same period, the amount should be calculated for making these adjustments. Is that clear?
Yes. Clear.
Perfect. Let's do this question now. On 31st March 2002, the issued share capital of the company consisted of how many zeros are there? 10 crore.
10 crores.
Consisted of 10 crore in ordinary shares of rupees 25 each and 5 lakh in 10% cumulative non-redeemable preference shares classified as equity of rupees 1 each. On 1st of October 2002, the company issued 10 lakh ordinary shares fully paid by way of capitalization of reserves in the proportion of 1:4 for the year ended 31st March 2003. Profit for the year 2001, 2002, 2002, 2003 are this as per the P&L account. Calculate the basic earning per share for both the years. So although I have not yet discussed the concept of the bonus issue, which I am going to talk about after this question, but bonus issue, drawing the reference from your IGAP knowledge, what is the treatment of bonus issue for the calculation of earning per share? Are those considered from the inception or they are also weighted for the number of days? What you were doing under the IGAP bonus
I
issue?
think it was from the inception date.
It was from the inception date, right? So since you know already this, so I hope you will be able to come up with the earning per share in that case, right? So just try your calculators quickly to calculate the earning per share for both the years. I'm waiting for you to respond.
Are the preference shares in the nature of liability in this case? Okay. Basic earnings per share for X1, X2 would be 0.0045.
Okay. I hope everybody has tried hands. So let's see how this needs to be done. So profit for the year given in the question for both the years. Less preference dividend 50-50. Then earnings available for equity shareholders is 500-400. Shares in issue for full year 4,000. Bonus issue on 1st of October, but bonus issue is always considered from the day one. So we will not give a weight, right? So 1,000 full is taken. So total number of weighted average number of shares is 5,000 only. Same for the previous year. So bonus issue not only considered from the inception date of the current year, but also considered from the inception date or, uh, of the previous year, beginning date of the previous year as well. So for the previous year as well, this 1,000 will be considered. So number of shares would be 5,000. So 500 divided by 5,000, 10 paisa. 400 divided by 5,000, 8 paisa. Simple.
Can I see the question again? For once. Profit is for like 50,000 only, X1, X2. And the number of equity shares is 10 crores.
So 4,50,000, 5,50,000, right? So 450 is for the previous year, right? So 450 we have considered here and 550 we have considered here for the current year, right? Then dividend and preference shares is how much? 50 for both the years. That is given in the question.
Yes.
5 lakh in 10% of rupees 1 each. So 1 each means 5 lakh. 5 lakh into my 10%, how much? 50,000. Right?
Right. Yes.
So it means 50 in thousands, right?
Yes, that's
Correct?
okay. Right. Yes.
Correct. So the amount attributable to the equity shareholders would be 500 and 400. Until now, everybody is clear?
Number of equity shares comes to 400, 4,000.
So number of equity shares,
40
how these are
lakhs.
calculated? So consisted of 10 crore in ordinary shares of rupees 25 each. So 10 crore divided by 25. How much number of shares we have?
40
See,
lakh.
10 crores is the amount. I thought it is the ordinary number of ordinary shares. Okay.
So that is an interpretation gap, but conceptually you are correct, right? So if you are considering it as a number by any chance, but applying the concept clearly, so that is helpful, right? So 10 crore is the total capital, right? Divided by 25 is the face value, right? So similarly
Yes,
here, like we did here, 5 lakh number of shares for rupees 1 each, right? So 5 lakh divided by 1 for 5 lakh and 10 crore divided by 25, right? So how much is this? 40 lakhs, right?
yes.
Or 4 lakhs, sorry, 4 lakhs over, I guess.
10 crores.
40 lakhs.
40 lakhs. Yes.
Okay. Then how how much the number of shares, removing 3 zeros because we are presenting in hundreds, right?
Yes,
So
now understood. Yes.
4,000, correct? So
Yes.
4,000 are the number of shares, and bonus issue always considered from the inception date. So considered in both the years. So total number of shares 5,000, and the EPS is 8 paisa, 10 paisa. Now, what this star means? So this star means because the bonus issue is happening in current year, right? So it was not issued in the previous year. Hence, while calculating the EPS for the previous year, we might not be aware that company is going to come up with the bonus issue in the next year. So in the previous year, how it had been calculated, ignoring this 1,000, right? So instead of 1,000, it would have been 4,000. So it would have been 10 paisa, right? But now we are preparing the financials for the current year. So we will reinstate the EPS for the previous year by considering the bonus issue as well. Understood my point?
Yes.
Right? Because when you were preparing the 2002 financials, bonus issue was not in place, right? So at that time, you were not aware that company will issue bonus shares in the next year, right? So how many shares you had considered? 4,000 only, right? So basis on the 4,000, you must have published the 10 paisa EPS for that very year. But now when you are preparing the financials for the current year and the comparative information on also needs to be presented, right? So EPS for the current year as well as EPS for the previous year needs to be presented on the face, right? So when you calculate the EPS for the current year, you consider the bonus issue as well. And bonus issue, by virtue of its feature, it needs to be considered in the previous year as well, right? So you will reinstate the EPS for the current year financial presentation, right? So that's why this star metric is marked and the notes are here.
Sir, preference share is classified as equity.
Mhm.
So why should not included in number of equity shares?
No, 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 no.
Non-redeemable.
No, 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 no. So, okay. So you have asked altogether a different question. So let me explain. So under Ind AS 32, Ind AS 109, whenever we say that we do not have the concept of the preference shares, right? It doesn't mean whatever the preference share capital is, we will add up that number of shares to the equity number of shares. No. Our equity share capital remains the same. Equity share capital will remain the same, right? Number of shares will not be impacted. We do not add the preference share numbers to the equity share numbers, right? What actually we do when we say we do not have the preference share capital, either it will be a liability or it will be equity, right? So if it is a liability, then it will be showcased under the non-current and current liabilities only, right? And if it is not considered liability and it is classified as equity, then it is classified as other equity, right? We do not alter the equity share capital at all.
Okay.
Okay. So that will be better understood when you actually do a couple of numericals around this preference share capital accounting under Ind AS 32 lecture, right? So until then you simply say that preference share capital is not presented separately on the balance sheet, and it is classified under other equity, and number of shares uh, which preference shareholders have are not added up to the equity share capital. So our equity share capital remains unaltered, right, by this accounting. Clear?
Yes, sir. Clear.
Okay. Let's do this question. Following is the data for the company XYZ in respect of the number of equity shares during the financial year 2001 to find out the number of shares for the purpose of calculation of the basic earning per share as per the Ind AS 33. 1st of April 2001, 15th of June 2001, 8th of November 2001, 22nd February 2002, and 31st March. So these are the 5 dates on which different activities are taking place. So on 1st of April, the question says the opening balance of equity shares is how much? 1 lakh. So number of shares, right? So this is the number of shares, 1 lakh. Then on 15th of June, additional equity shares are issued. How many number? 75,000 new shares are issued. Then on 8th of November, conversion of convertible preference shares into equity. So it means again new equity shares are issued. How many? 50,000. Then on 22nd February, company came up with the buyback offer from its shareholders and bought back 20,000 shares, right? And then closing balance as at 31st March is 2,05,000. You need to calculate the weighted average number of shares. Denominator. Now, we are not talking about the numerator, we are talking about the denominator. So, considering your IGAP expertise, will you be able to come up with the weighted average number of shares?
Yes, we'll try.
Sure. I'm waiting for your answers.
Is it 1,77,657?
Okay. Others? Everybody has tried?
1,96,780.
Mhm. So two answers are coming. Any other person is also trying? Just match your solution where you are right and where you are mistaken.
So mine comes 1,77,657. Maybe approximation, I think.
So maybe you might have slightly used a different number of days somewhere.
Yes, for conversion, I took 143 days out of instead of 144 days. That's the only difference.
Okay. So you are very close. Okay. Okay. What is the policy of considering the number of days? So let's discuss, right? Because if the days are mistaken, certainly the answer will deviate, right? So when we do the transaction on a particular date, for example, the transaction is happening on 15th June, the transaction is happening on 8th of November. So are these dates inclusive or excluded? What do you think?
These are included.
These are included, right? Because everything which we consider is at the closing day, right? So at the closing day, this transaction is already happened. Yes or no?
Yes.
Right? So at the closing day, so closing day means during the day, whatever the transaction is happened is forming part of that particular day, right? So for that particular day, this transaction is considered. So starting from 15th June until 31st March, how many days, right? So how you will arrive at? Simply deduct the dates 31st March minus 15th June plus 1, right? So follow the rule of plus 1, correct? Is that clear?
What I do is, suppose I took 31st March and minus 14th June instead of 15th June. I reduce one day.
Okay. So you deducted 14th June, right? So in that way, it is also same, right? Because if you deduct 15th June and then add, or if you deduct 14th June without adding one, I think answer should be the same.
Yes, answer would be same.
Correct. So ideally, the approach should be this only. So deduct the delta between the two dates plus one, delta between the two dates plus one, right? Any doubts after looking at the solution?
Yes, sir.
Clear, or anybody you want to ask anything?
Sir, I added buyback shares instead of deducting. So I get the
Yeah,
difference.
I understood that because you were saying somewhere around 197, right? So I understood that. So buyback of shares is what? That reducing, it is reducing the number of shares outstanding, right? So it will be deducted. Clear?
Yes.
So the approach which we have used in the calculation is also explained how we are going to perform these calculations. Maybe let's read it once. The closing balance of the outstanding shares is 2,05,000 by normal addition and subtraction as given in the question as well. But as per the weighted average concept given under Ind AS 33, one need to find out for how many days each type of shares was actually held during the year, right? So that's the concept. Simple addition deletion is 2 lakh 5,000 is the answer, right? But standard is not saying that you just use this number. Standard is saying it should be weighted basis on the number of days for which the shares were actually outstanding. The shares which were there on 1st of April 2001 were held for the whole year. Therefore, the weighted average number of such shares will be given by the formula number of shares into my number of days the shares were held divided by 365. So, are we going to use always 365 or can we use 366 as well?
In a leap year, I will use 366.
Correct. So be careful if in your examination the year ended is falling in the leap year, right? Everybody knows the leap year, right? Leap year concept,
Yes, yes.
right? So if the year ended in your examination question is the leap year, then you should use 66, right? 366, and also give a note in your solution, right? That considering this year is a leap year, we have considered the calculations for the weighted average number of shares basis on 366 days, right? Or if you don't want to mess up, then also give a note that we have used the 365 days for the calculation of weighted average number of shares, right? So that in case, because we do not know what would be the suggestive answer institute is carrying, right? So if institute suggestive answer does the calculation basis on the leap year 366 and we are using 365, then it will be a different answer and we do not know, if we get the lesser marks or not, right? So there is no standardization, right? But to be better prepared, we should quote assumption in that case, in case our examination year ended is the leap year. Is that clear?
Clear.
Then we are using 365 in this case because this is 2001 anyway, doesn't matter, right? Then the shares which were issued on 15th of June were held only for 290 days. So 75,000 into 290 divided by 365, right? This would be the number. Following the above formula for all the transactions, weighted average number of shares for the calculation of EPS will be calculated, right? And that's what we have done. Correct? So this is how we are going to present our answer in the examination so that we do not lose marks. So the only correct answer doesn't guarantee you full marks. A better presentation is also required, right? So your presentation of the solution should be, crisp and clear. So always use this tabular format for all these, presentation. So although you could have performed in the working notes in the paragraph, you could have mentioned, right, like this. You could have done this way as well, right? You could have performed 5 lines and making this happen, right? But this presentation doesn't look as good as this presentation for the examiner to understand what all you have done in this question, right? So try to use the smarter presentations, generally the tabular formats. Is that clear?
Clear.
Perfect. So let's try our hands on this example as well quickly before we wrap up session for the day. And anyway, we have 2 more sessions for this standard. So we will have a lot of discussions and a lot of practical questions in next 2 sessions. But for today, before we wind up, I think we can pick this up, right? We have 9 minutes left. Basic EPS weighted average number of shares, right? On 1st of January 2010. Now, please be careful in the examinations. Don't always assume that year ends on 31st March, right? How you will be come to know whether the year is ending on 31st March or 31st December or 30th June or 30th September, right? By looking at the date of the balance at the beginning. Is that clear?
Clear.
Right? Because if question says opening balance or beginning balance was on 1st of January, then it means the ending balance would be 31st December. And now you need to perform all calculations from 31st December, not from 31st March. Is that clear? Then
Yes, clear.
on 31st of May, there are new shares issued for cash, right? How many? 800, right? And then on 1st of 12, there are purchase of treasury shares for cash. How many? 250. And the shares which have been purchased earlier in the previous year, which are not yet cancelled, are coming as opening balance. So, do you know the difference between the shares bought back, which are held without cancellation, regarded as treasury shares, and the shares bought back and cancelled? What is the difference between the two terms? Shares bought back, not yet cancelled, and share bought back and cancelled.
What is treasury shares?
So treasury shares means the shares which are bought back by the company from the shareholders but are not yet cancelled.
Okay.
Clear? So shares which have been bought back by the company, that is, they are sitting with the company only now, but they are not yet cancelled. So my equity share capital is not deducted or reduced by these number of shares. That what cancellation means, right? Suppose I had issued 1000 shares. Let me take an example, right? 1000 shares, and I bought back 100 shares. Then eventually, how much capital I should carry in my balance sheet? 900.
Yes.
But I will continue to present 1000 shares as my equity share capital unless and until these 100 shares are actually cancelled after taking the board of directors approval in any of the board meeting. Is that clear? So until then, these 100 shares will be regarded as the treasury shares because they are sitting with the treasury department of the company who has actually invested money in the company's own shares. Clear?
Yes, clear.
Now, balance at the year end 2800, 550, and 2250. Now, you need to calculate the weighted average number of shares outstanding for the purpose of calculation of earning per share. So, that is with this limited information, you are supposed to calculate the denominator only. Correct? Now, to calculate the denominator, there are two approaches which I have presented in the solution, right? So, whichever approach you like, you can follow. But I advise always practice with one approach. If you are practicing both the approaches, then in examination you might make a mistake, right? So always practice one approach. So one approach could be original number of shares as 1700, that is this one, after removing this treasury, right? Because for the purpose of calculation of EPS, I will not consider these treasury shares, right? Because they are about to be cancelled, right? They are not in issuance. So my opening number of shares is how much? 2000 or 1700? Always 1700. Treasury shares are always excluded for the purpose of calculation of weighted average number of shares under Ind AS 33. You can make a note of this somewhere in important notes if you are noting the key messages during the lectures discussion somewhere separately, right? So treasury shares are always ignored for the purpose of calculation of weighted average number of shares, right? So 1700 into May, 5 by 12. Now, why this 5 I have taken? Because my next transaction is occurring on 31st May. And until 31st May, from 1st of January, how much period is this? January, February, March, April, May, 5 months. And in this example, the calculation is being performed instead of number of days on the months basis. So that is okay for understanding. But in examination, I always advise to strictly follow the number of days calculation, right? Then 5 divided by 12, then plus 2500 is issued, right? Now, how it has arrived? 1700 plus 1800. So new number of shares is how much? 2500. So 2500 for 6 months. Why 6 months? Because from 31st of May till 31st of 1st of December, how many months are these? 6 months. So 6 months by 12. Then plus 2250. Why 2250? 2500 minus 250, because 250 shares again bought back by the company, right? And for how much period this is outstanding? Only for 1 month, right? Because the transaction has occurred on 1st of December. So this is the answer, right? I generally advise not to use this approach, right? Because this is more cumbersome as compared to the next approach. 1700, the opening number of shares, number of shares for the full year. So into my 12 by 12 plus 800 issued from which date? From this date. So this date to full year, how many months? 7 months. Divide by 12. Then this is bought back on this which date? This date. So 250 is bought back into my 1 by 12 minus, right? And then 2146. So answer will anyway come same. In my view, the second approach is a better approach and the easier approach and less prone to errors, while the first approach looks complicated. So that is up to you, right? This is all mathematics. Which way you want to go, or which way is you are more comfortable, you can opt for. I advise the second approach. Clear?
Clear. And I also prefer second approach.
Yes, because second is easier actually.
Easier actually, yes.
Yeah, because you are not going to calculate the dates for all the dates. You are simply using the transaction date and the closing date, transaction date and the closing date in the second approach. But in the first approach, you are computing the delta between the two dates.
Two dates.
Right? So that is difficult actually. Okay, so until now, whatever we have discussed, is everything okay, clear, taken by you, or any doubts, questions you want to ask? Because it is 10 o'clock, so I am happy to wind up the session now. We are left with a couple of minutes. You can ask anything in case there is anything.
Sir, in the solution first approach, 2500 into 7 by 12 instead of 6 by 12. Is it right?
Why 7 by 12? 6 by 12 only, no? 1st of December minus 31st of May.
Okay, sir.
Right? So that's why I'm saying don't use the first approach. Just for knowledge purposes, I discussed that, right? So that you are aware that this is another way of calculating the things. But I advise strictly to use the second approach only. Fine? Okay. Then if no questions, I can assume whatever we have discussed is well understood. Perfect.
It's clear for me. Thank you very much.
Thank you. So thanks everyone for listening me patiently and making this lecture participative. I really enjoyed talking to you all, and we meet in our next session, and the remaining portion we will cover in the next sessions. Wish you all the very best. Have a good day. Bye.
Thank you, sir.
Yes, session is over.